The psychology of investing, fear, greed, and the crowd. The stock market is often seen as a machine of logic, a place where numbers, profits, and forecasts determine value. But behind all that data, one powerful force truly drives the market: human emotion. Fear and greed, the twin engines of market psychology, have moved prices, created fortunes, and caused disasters for as long as markets have existed. The human element. For centuries, people believed markets were rational, that investors analyzed information carefully and made logical choices. But history has shown time and again that's not how things really work. When prices rise, excitement spreads. People fear missing out. They buy not because of careful analysis but because everyone else is buying. And when prices fall, panic sets in. Investors rush to sell, often at the worst possible moment. The truth is, markets are not just driven by numbers or year earnings reports, they are driven by people, each with their own hopes, fears, and biases. The cycle of emotion. Market psychology follow a rhythm, an emotional cycle that's repeated for centuries. It starts with optimism. Prices begin to climb and investors believe opportunity has arrived. Then comes excitement. Stories of easy money spread and more people jump in. At the peak, euphoria takes over. Risk is forgotten, and everyone believes prices can only go higher. Then reality sets in. A few pieces of bad news appear, confidence starts to crack. And anxiety creeps in, fear spreads, and panic selling begins. Soon after comes despair, the market bottom. But eventually, conditions improve. A new brave investors start buying again. Hope returns, and the cycle starts all over. Technology changes, markets evolve, but human emotion that never really change. History is basically a mirror of our collective emotions. In the 1630s, during tulip mania in Holland, the price of a single tulip bulb rose higher than the cost of a house, not because tulips were more useful, but because people believed the price would never stop climbing. In 1720, the South Sea bubble in Britain made people believe overseas trade would make everyone rich. Even scientists and politicians poured in until reality hit and the bubble burst. In 1929, the US stock market crash wiped out decades of prosperity and sparked the Great Depression. Fast forward to the early 2000s, the dot com bubble. Internet startups with no profits were valued in the billions. When the illusion broke, trillions of dollars vanished. Different times, different players, different technologies, but the same emotions every time. Greed during the rise, fear during the fall. Behavioral biases. Psychologists have a term for these emotional traps: behavioral biases. They are patterns of thinking that cause us to make irrational decisions. Here are some of the big ones: herd behavior, following the crowd instead of thinking for ourselves. When everyone's buying, we buy. When everyone's panicking, we panic too. Confirmation bias. We seek out information that supports what we already believe and ignore anything that challenges it. Loss aversion. The pain of losing money hurts twice as much as the joy of gaining it. That's why people often sell winners too early and hold on to losers too long. Overconfidence. Believing we are smarter than the market, that this time we will know exactly when to get in or out. These biases don't just affect individuals. When millions of people act on them at once, entire markets move. The role of media and technology. Today, information moves faster than ever, and so does emotion. Social media, online forums, and 24-hour news amplify every headline, every rumor, every hot take. A single tweet can send a stock soaring or crashing in minutes. Think back to 2021, the GameStop saga. A group of small online investors took on Wall Street hedge funds, sending the stock up thousands of percent in just days. It was not about the company's value, it was about emotion, momentum, and community power. Technology has connected us like never before, but it's also amplified herd behavior. One viral post can turn local excitement into a global frenzy overnight. Fear and greed indicators. So, can emotions actually be measured? In a way, yes. Analysts use something called the Fear and Greed Index. It tracks investor sentiment using data like volatility, momentum, and trading volume. When greed dominates, the market's usually near a peak. When fear takes over, we might be near a bottom, and that's often where opportunity hides. As Warren Buffett famously said, be careful when others are greedy and greedy when others are fearful. The best investors don't ignore emotion. They understand it, control it, and often move in the opposite direction of the crowd. Rational minds in an irrational market. The market will always be unpredictable. Prices can rise or crash after than logic can explain. But amid all that noise, calm and disciplined investors can thrive. Good investing is not about predicting emotion, it's about mastering your own patience, discipline, perspective. When everyone else is euphoric, ask yourself, what is this company really worth? And when panic sets in, remember, markets recover. They always have. The crowd and the individual. Crowds can be powerful, they can build entire economies, but they can also be wrong, very wrong. The challenge for any investor is to think independently, to question the noise, to act not with the crowd but with conviction. As legendary investor Sir John Templeton once said, the four most dangerous words in investing are this time it's different. Closing thoughts. Fear and greed, they are not just market forces, they are reflections of human nature itself. We can't eliminate them, but we can learn from them. Those who understand emotions, both their own and the crowd's, hold one of the greatest advantages in investing. Because in the end, the market is not just a chart of prices, it's a chart of human behavior. And in the next chapter, we will explore how that behavior shapes market cycles and economic forces, why every boom leads to a bust, and how every crisis carries the seeds of renewal.